Then building permits have rolled over and are falling. And what you notice here, with the exception of this false flag right here, when they roll over, a recession is just behind. And here with the exception here, it's sort of, in 1998, it didn't really roll over that much. It just slid. But it predicted the global financial crisis pretty well. But look at what's happening now. It's been rolling over since late 2021, early 2022. So we're headed for something that's probably not going to be very good. The case freight index. Now the freight index, this is very important because if we've got this booming economy and we've got this booming stock market, it means that all those companies in the stock market should be building and selling more stuff that has to be shipped to somebody. If the freight index is falling, it means that, and it dropped 9.3%.
A significant event is taking place in the background. The commercial real estate sector, which was once the foundation of the American banking system, is currently experiencing a gradual collapse. The damage is being frantically concealed by banks behind accounting tricks. Loans are defaulting and office towers are half empty. Mike Maloney characterizes it as a slow-motion catastrophe, cautioning that the current situation will be significantly more severe than 2008, due to the fact that it is not solely focused on housing. It encompasses all offices, retail, credit markets, and regional banks that have never entirely recovered from the previous crash. In addition, Peter Schiff asserts that the genuine repercussion is not merely another bailout or recession. It signifies the cessation of confidence in the US dollar. Gold and silver, he contends, are already indicating what is to come. This is the time to be attentive if you possess gold or silver or intend to acquire them.
Help with their mortgage greater than they were in 2008, the global financial crisis. This is insane, and this is honest data that anybody has access to. If you search for, Google searches for "give car back" are near all-time highs, and that's from Darth Powell. So this is another one, "give car back." Then building permits have rolled over and are falling. And what you notice here, with the exception of this false flag right here, when they roll over, a recession is just behind. And here with the exception here, it's sort of, in 1998, it didn't really roll over that much. It just slid. But it predicted the global financial crisis pretty well. But look at what's happening now. It's been rolling over since late 2021, early 2022. So we're headed for something that's probably not going to be very good. The case freight index. Now the freight index, this is very important because if we've got this booming economy and we've got this booming stock market, it means that all those companies in the stock market should be building and selling more stuff that has to be shipped to somebody. If the freight index is falling, it means that, and it dropped 9.3% year over year in August, hitting its lowest level since 2020. This is really bad news. Late rent payments continue to tick up, and late rent payments are skyrocketing from Darth Powell. And they are. Look at that trajectory here. And this is, all in 2025, this turnaround. It was falling on the average, and then suddenly, this year, it just started to take off like a rocket. So we're in some trouble. This is used cars. So this is CarMax. So this is what used car stocks are doing. Look at that plummet, and this was based on sales and earnings. The stock plummeted, so used cars are in trouble. Turning to the stock market, Swing Trader says this short will be more rewarding than the COVID crash or the global financial short. Well, I'm not shorting anything. There's a potential for some serious losses when you short or some big gains. Feel free to do whatever you want. I don't give financial advice. But look at this trend line. There's 1, 2, 3, 4 hits establishing a very, very solid trend line. And look at where we are. We're up out of the top of it, meaning that a huge crash can happen. The correction can be enormous, and we are in dangerous area. The S&P 500 versus job openings. Look at the great correlation that they had in the past. When one is going up, the other one is going up until the beginning of the end of 22, beginning of 23. So this divergence is really bad, and it's been going on for several years now. And so something is going to break, and when it does, I believe it's going to be horrific. Spencer Hakamian says, AI boom versus dot-com bubble, scary. Now, there's no time scale on here, but the time scale is here. This is 4 years, 98 to 2001. This is 23 until now, which is only 2 years, but you'll notice that the line here is not done yet. So they're probably on the same time scale. Now, I wish that he could have shifted this, made this go up to a scale of 8,000, and then shifted this by this 1 notch, because what you've got here is a factor of 5, and this is also a factor of 5, and it would be great if he could have lined these 2 lines up so that they start at the same point, because you'll see that today's climb is much steeper than going into the NASDAQ bubble. This is insane. Shiller PE at 40.15. Now, this is the Case-Shiller cyclically adjusted PE ratio that he's talking about here. And he's got a mean and median at 17 or 16. However, that's if you take just like this century. It isn't even this century's data. It goes back a little bit further. But if you take this back all the way, and I have, you'll see that if you add another century of data, this fair value is somewhere around 12 to 15, not 16 to 17. That in the last century, PEs this high were considered bubble territory. Now, 40 is bubble territory, and this is considered the mean. It's totally insane. I think we're going to get back to realistic valuations like we were at in the last century. MAC 10, the last time we had Dow Theory non-confirmation, global markets crashed. And so he's got 2 non-confirmations here. And the first one, you're looking at the Dow Jones Industrials are in black. So these are the companies that make this stuff. The Dow Jones Transportations are in red, the companies that ship the stuff. And they were rising, and the Dow Jones hit a double top while there was a divergence, a fall in the transports. Here we have the Dow Jones just dramatically going north, and the biggest divergence in history with the
concrete data is the starting point for Mike Maloney. Downtown vacancy rates in Denver have surged to nearly 37%, and delinquencies on commercial mortgage collateral securities have surpassed 27%, which is nearly triple the national average. Banks have been extending and modifying loans for over 2 years in order to conceal these losses. However, the figures are no longer concealable. The majority of the $900 billion in commercial real estate debt that will mature in the next 24 months, is associated with properties that have experienced a 25 to 40% decline in value. It is impossible to refinance at the current exorbitant interest rates, which are multi-dead, without acknowledging insolvency. Maloney cautions that the contagion will spread through regional banks, credit markets, and pension funds as defaults accelerate, triggering a chain reaction that is remarkably similar to 2008, albeit on a larger scale. he substantiates it with commonplace data. Year over year, freight volumes have decreased by roughly 9%. Since late 2021, the number of building permits has been declining. Nationwide, there is an increase in the number of late rent payments. The prices and sales of used cars are experiencing a significant decline. In the interim, Wall Street continues to celebrate record stock prices, oblivious to economic reality. According to Maloney, this illusion of strength consistently manifests immediately preceding the breach. Peter Schiff subsequently establishes a global connection. Gold has experienced a year-to-date increase of approximately 56%. Silver has surpassed its nominal zenith from 1980, and both metals are experiencing a surge in value as a result of investors' diminished confidence in paper assets. Schiff refers to this as the initial phase of a generational revaluation, a phenomenon that parallels the 1970s, when gold experienced a significant increase in value from $35 to $850 per ounce due to inflation and debt, which undermined trust in fiat-based currency. Currently, central banks from China to Turkey are purchasing gold and selling U.S. treasuries. The dollar's status as the global reserve currency is diminishing. Schiff cautions that the demise of this confidence will result in a currency crisis that dwarfs 2008, as well as soaring interest rates and expanding prices for Americans. Even significant institutions are awakening. Morgan Stanley recently suggested a 6-to-1 2020 portfolio that allocates 20% of its assets to gold. Schiff emphasizes the earnings of miners such as Agnico Eagle and Pan American Silver, which are experiencing a significant increase in revenues, despite the fact that Wall Street continues to consider them undervalued. Additionally, the most recent data from 2025 serves as confirmation. Fed rate reduction bets and record central bank demand have driven gold to $4,100 per ounce. London liquidity was at a record low, and silver surged past $50. Citing global constraints, HSBC increased its 2025 silver forecast to $38.56. According to the World Gold Council, 77% of central banks intend to continue increasing their gold reserves this year. These are no longer predictions. Presently, they are occurring.
Spot silver is at $52.20. It's actually, you're quoting December futures,
Correct.
which are normally above the spot market. They're actually below. I think we're setting ourselves up for a huge short covering rally. But this is an all-time record high for silver. It's eclipsed the peak from 1980. Now, not adjusted for inflation, but just the nominal price is now higher than at any point. And in fact, gold year to date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s. And we still have 2.5 months left. But when gold started to move like this in the 1970s, it was the beginning of a huge move. Gold went from $35 an ounce when we began the decade to $850 when we ended it. So I think this is the beginning of a much bigger move in both gold and silver. And, you know, first of all, what it tells you about the stock market, the U.S. stock market's really been in a bear market for 26 years, because in 1999, the Dow was worth 45 ounces of gold at its peak. It's now worth barely 11. So that's a 75% decline in the real value of U.S. stocks measured in real money. But I think what we're seeing now is a warning sign, similar to the warning that we got in 2006 when subprime blew up. That was warning about the financial crisis that hit the following year. I think what we may see next year is a U.S. dollar and sovereign debt crisis. The world is divesting of U.S. dollars. Central banks are unloading dollars in treasuries, and they're buying gold. And I think this means the U.S.'s ride on the global gravy train is coming to an end, because we base our whole standard of living on the dollar's reserve status. We use that to consume more than we produce and to borrow more than we save. And when the world doesn't want our dollars anymore, we're not going to get their goods. They're not going to loan us money by buying our bonds and our mortgage-backed securities. So Americans are going to be looking at much, much higher consumer prices, much higher interest rates, And this sovereign debt and currency crisis will make the 2008 financial crisis look like a Sunday school picnic. Well, first of all, you don't have to buy a whole ounce of gold. You can invest whatever you want. You can buy gold ETFs. You can buy fractions of an ounce. And silver, people can buy silver $52 an ounce. You can buy plenty of ounces of silver. We sell silver and gold at Schiff Gold. But I really like the mining stocks. Pan American Silver is probably the highest quality of the silver miners. It's not up as much year to date as like a Coeur d'Alene or a Hecla. But if you look at a longer-term chart, Pan American didn't go down nearly as much as those stocks did, so it didn't have that lost ground to make up. But it's a great quality name if you're just going to buy one and you want less downside risk. Agnico Eagle also hasn't done as well as some of the lower quality miners in the last few months. But zoom out, it's been a phenomenal stock. Okay. AEM right now is $171 a share. I've owned it for 20 years. I bought my first shares below $10 a piece. So it's been a huge winner in the gold space when a lot of other gold mining companies were having a lot of difficulty. But pretty much now you can just throw a dart. I don't see how you don't make money buying any gold stock or silver stock. I think the whole group is ridiculously cheap. And the earnings are exploding. There's no other sector of the market that has the earnings growth that gold and silver companies have. And Wall Street has completely missed the boat so far. They haven't been invested. In fact, a year and a half ago, they were putting sell signals out on the mining companies because when gold was at 2,000, they thought it was the top. They said that there's no upside in gold. Well, it's more than doubled since then, and Wall Street still hasn't really embraced these names. Now, I'm just starting to see, for the first time, I've been in the financial industry for 35 years. This is the first year that I've seen any firms, like Morgan Stanley came out and said maybe the 60-40 portfolio should be 60-20-20 with 20% gold.
Right.
So I think investors are just starting to buy.
Therefore, it is imperative that each investor pose the following inquiry. When the dollar's global dominance is threatened by the next wave of defaults, will your wealth remain in paper promises or be safeguarded by tangible assets? Mike Maloney cautions that the illusion of stability is coming to an end. Gold and silver are not speculative trades, according to Peter Schiff. They are lifeboats in a financial ocean that is disintegrating. The institutions that mocked precious metals a year ago are now discreetly stocking up. The intelligent money has already begun to circulate. Do not wait for the headlines to corroborate it. It will be too late by the time they do. If you prioritize truth over narrative, please like, subscribe, and share this video. Become a member of our expanding community of investors who are determined to avoid being taken by surprise once more. History does not reward those who react. Rather, it rewards those who prepare. I am curious to know whether you will continue to trust the banks after the system resets, or if you will shift your trust to the actual thing.